Hello and welcome, everyone, to the latest episode of the Responsible Edge podcast with me, Charlie Martin. Join us each week as we learn from experts on how to build our startup, the Anti-Greenwash Charter, as successfully and ethically as possible. So today I was delighted to be joined by Roman Cassini. Roman is the portfolio specialist and head of ESG at Hosking Partners, leading their ESG efforts since I think 2021 when he joined the firm. He has a really interesting background covering working in the UK's Ministry of Defence and being an officer in the British Army, amongst other things. Had an absolutely fantastic conversation with Roman today, obliterated our normal timings for a show. It's about an hour or so that Roman and I spoke for. He just had such a fascinating way of introducing some very complex and important topics around investment and investment strategies at a macro level, looking at how we can utilize investment to better support the energy transition required, looking at active ownership and the importance that we as shareholders can play in adapting or influencing the behavior of the organizations we invest in, and also the importance of looking at investment from a long-term perspective. So amongst other things, I should say, there was a real plethora of topics covered with Roman. Just want to say a big thank you to him for joining us and giving us up some of his time and introducing us to these topics. As always, thank you for listening in. If you've got any questions for either ourselves or for Roman, please feel free to get in touch. And thank you again for listening. Well, Roman, the first thing to say is a big thank you for joining us for an episode this morning and giving up some of your time. I know we've had to try and sort of get calendars to align over the last few weeks as things have been up and sort of fluctuating, if you like, from either end. But thank you very much for joining us today. It's great to have you on.
It's a real pleasure to be here, Charlie. Yeah, thanks for having me.
And now I think that of all the people that we've had on the show so far, we've definitely not had somebody with your background on before or anything like it. So as always, really keen just to kick things off by understanding a bit more about your history. And specifically, and I know we spoke about this when we met for the first time, those things that have really inspired you in terms of your career choices relating to kind of ethical and responsible practice. That would be particularly interesting for our listeners.
Yeah, sure. So I work currently. I'll start at the beginning. I'll start where we are now, and then I'll go back to the beginning. But at the moment, I work for an asset manager, in the investment industry, and I've had a reasonably roundabout route to getting here. It is an industry which is known for its specialists, so people that will study finance at university or economics related subjects, go straight out of university into an internship, working for a bank or a large asset manager, and then continue their career from there. And I work with a lot of people that have done exactly that and who are real experts in their area. I have a slightly more roundabout route. So I studied humanities at university. I did an English degree. And at that point, I actually wanted to be a conflict journalist. When I was at university, it was kind of the height of the war in Afghanistan. And when I was a teenager, the war in Iraq was going on. And it seemed to me like those were the really exciting, dynamic parts of the world to be in, where you could go and make a difference quite quickly. And I always, I suppose, had that desire to work somewhere where you could have an impact in some way. And my attitude was, while you may agree or disagree with the bigger picture of what's going on somewhere at a local level, you being there or not being there means that you can be the one making a decision instead of someone else. And hopefully you can, make a slightly better decision. Slightly idealistic teenage thinking at the time.
Sorry, Roman. I'm fascinated by this. So, as an idealistic, as you described, teenager looking at what's going on in Afghanistan and Iraq. When it comes to journalism, like, what was the impact that you saw that you could possibly have in terms of that role within?
Well, I mean, that's a great question. So I didn't. This is what I wanted to do as a teenager. I thought, as a journalist, you can have a Without being maybe directly involved, my idea was, you can go and discover the stories that are unknown and tell them to the world, and then someone else that has the power to go and make a difference to them can get involved, and by spreading awareness, you can help with whatever particular cause it is that you were trying to get at. And broadly speaking, I think that is what the best journalists out there are doing. But when I went to university, to pick the story back up again, and this will answer your question, I think, a little bit. When you're 16, 17, 18, you kind of have a rough idea of what you want to do. And then I think people get to university and they start thinking, okay, how do I actually do that?
Mm-hmm.
And as I saw it at the time, it seemed to me like there was sort of two paths you could go down. You could either, if you wanted to be a journalist working in a conflict zone, you could either go out as a freelancer and just buy a one-way plane ticket to, well, perhaps not Afghanistan, but somewhere in sub-Saharan Africa, or somewhere where there was a story that was perhaps not fully appreciated by the wider media and wider global population, and go and try and unearth it. And it was the kind of romantic view of journalism. Or you could join a large media organization and go out as a embedded journalist working alongside the troops on the ground in whatever situation it was. And obviously those were the journalists mainly that I was exposed to through, most people are exposed to when you turn on BBC News and you go and see the journalists who are working with those troops. So I thought, okay, well, although the romantic idea of being a freelance journalist is appealing, I kind of was a little bit realistic about it. And I thought maybe let's try and do something a little bit more mainstream to begin with, and get my feet in the door somewhere and get some experience under my belt, and then I can maybe think about something a little bit different later on. And so this led me to look at a short service commission in the British Army. So joining as an officer, and you go and do 4 years and you get all of the training. And I thought, well, I'll go and do that, and then you can come out the other side, and it's quite useful experience to be able to go and say to BBC or Sky, hey, I've got an English degree so I can write, but also I've got military experience, so you can embed me straight in with a military unit, and I'll roughly know the procedures and tactics they're using, and it makes you more employable, or at least this was my thinking. So in my second year of university, I joined the kind of reserves. There's a university reserve unit that you can join, which is designed to trying to get young graduates into the officer stream. And I really enjoyed that, and I applied for Sandhurst, and then after I finished my university degree, went to Sandhurst. And essentially what happened over the course of the first, quite quickly, to be honest, I mean, partly even while I was still in university, but then through Sandhurst in the first year, once I came out of the other side of Sandhurst and joined an amazing infantry unit in the British Army called the Gurkhas, the Royal Gurkha Rifles, who, slightly unusual unit, work with soldiers mostly from Nepal. We might come back to that. But what happened was I actually really enjoyed my time in the army, and I found that, and simultaneously I became a little bit disenfranchised with the idea of working in a large media organization. And I thought, actually, what I really want to do is, if I want to go and have an impact, perhaps I can have more of an impact in the army than I can as a journalist. And I had to drop, I suppose, some of the more idealistic elements of what I was going for with journalism and making a big difference. And kind of going back to what I said at the beginning, I realized that actually perhaps making a local difference, where the cause-consequence cycle between you making a decision, seeing an output, reacting to the decision, and carrying on is really tight. It seemed like that was really, really fast in the army, and that appealed to me. And there were other elements. I really enjoyed the camaraderie and all of the other stuff that people often talk about when they mention the military. So I did, I went and joined this unit in the Gurkhas. I ended up doing 5 years working in the battalion. I didn't actually end up going to Afghanistan at that period. The war there was kind of winding down. It was still ongoing. This was in 2012, 2013. Well, by the time I got out of Sandhurst, it was 2014. And so it was coming out of the back end of the high intensity conflict that I'd been seeing when I was at university, and it was transitioning into a different phase. And the unit that I was with didn't end up getting deployed there. But I did a load of other really interesting things, went and learned the Nepali language. I lived in Borneo for 3.5 years. I did I was deployed on operations in Africa, in Mali, and it was a really, really interesting period. And I think it did end up ticking off a lot of those boxes. I got to see a lot of the world, and I got to see a lot of parts of the world that in my current career I now look back on and think, actually these are parts of the world that we really need to think about when we're trying to deal with complicated problems that we'll come on to discuss, like climate change and the energy transition that's designed to try and mitigate climate change.
And Roman, by the way, that was absolutely fantastic. I do feel like there's a movie in the works for your background and the things that you've gone through. I mean, dropping in the fact that you've learned Nepalese is quite something. I won't test you on that because I won't.
Yeah, it's a little bit rusty. Sometimes I go and chat to a lot of the security guards. That I work just down the road from Whitehall, and a lot of the security guards outside places like the Cabinet Office are ex-Gurkhas. So sometimes when I'm passing by, I surprise them by offering them a little bit of very rusty Nepali. But yeah, I wouldn't want to. There are lots of people out there who are not only a lot better at Nepali than me, but there are some pretty incredible people in the military that go unrecognized, that have got stories that are a lot more movie worthy than mine.
Wow, that's very well. Still, in terms of what you've shared there, I think it's fascinating. I want to ask you as well. I know you're going to come on to talk about perhaps some other career moves, if you like, before you found yourself in your current role. But right at the beginning, you mentioned how you've got a fairly nuanced, I think you called it a very sort of holistic, if you like, experience that led you into doing what you're doing now within asset management. What are the things about your experience? I mean, you alluded to it there in terms of traveling the world and therefore having a sort of a broader understanding and appreciation of some of the issues at play, like the real world issues that are at play. But what other things do you think your experience have taught you that have allowed you and enabled you to go into what you're doing now as successfully as you are?
Yeah, I mean, that's a great question that leads me into kind of what I ended up doing next, which was, so spent for about 5 years in training and then working in unit with the Gurkhas. And then after that, I got this amazing opportunity. It was just in the right place at the right time, and I suppose knew the right person, which is often the case in these things, to go and work in the Ministry of Defence, in central government, on essentially doing counterterrorism at the strategic level, UK-based counterterrorism. And we also did a little bit of civil contingencies, which is things like flooding, wildfires. Basically, what the team that I was sat on did was, whenever the British Army is deployed within UK borders, which is actually legally quite a complicated thing, you can't, or very rarely will the Ministry of Defence deploy soldiers in its own, by itself. What normally has to happen is that another department, the Home Office or the Cabinet Office or whoever, will make a request to the Ministry of Defence saying, hey, we need some help. And there are some standing operations that exist that can facilitate this. Lots of the counterterrorism stuff is you just have operations that are written in the background and they're good to go. But then a lot of the civil contingencies stuff, like flooding, will basically be if a local fire service or police force or whatever it is becomes overwhelmed by the scale of a particular crisis, then they'll make a request to the military to say, hey, could you come and support us with some soldiers or some capabilities that we don't have? So our team would receive these requests and then it basically figure out what we were going to do and whether we could respond and how we were going to go about delivering that response. And do you want to jump in?
No. Sorry, I whispered fascinating because it was.
Yeah, I mean, it was amazing, and I was working with an incredible team. Just one of those moments where the stars aligned, and it was a really interesting, fun couple of years. And I then ended up the next 2 years after that, which basically saw me out of the whole 9.5-ish years that I did in the military. We're working in similar areas. I actually did end up deploying to Afghanistan, doing something slightly different back in 2020, about a year before the withdrawal, and then came back to the UK and did a little bit more counterterrorism stuff. But the overall point that I'll pull out from all of that was, I did quite a lot of work working with. I was hearing a lot of intelligence. We were working with intelligence people that are focused on intelligence, both in defence and elsewhere, and then also risk management. And I think these two things informed and gave me experience that is actually really useful and transferable into investment and asset management. Because firstly, for intelligence is basically trying to build a jigsaw puzzle of the world out of a load of disparate pieces of information. And it's not just trying to build a jigsaw puzzle of what the world looks like right now, but also what the world might look like tomorrow or in a week's time or in a year's time. And that's relevant to investment. We can come back to that. But then risk management is also really interesting, because what you're trying to do there is identify and mitigate problems before they occur. And the tricky thing with risk management is, if you do it well and you identify and mitigate a problem so that it doesn't happen, it's incredibly difficult to measure your success at that, because you have to measure a counterfactual. So you have to compare yourself against something that hasn't happened. Did it not happen because of something you did, or did it not happen because of chance? It's really difficult to know. On the flip side, if you're trying to identify and mitigate a risk, or if you do identify the risk, but then it happens, so you failed to mitigate it, again, it's quite difficult to actually judge the extent of that failure, because you don't entirely know whether you partly mitigated it and it could have been worse, or you failed to mitigate it completely, or perhaps you even failed to identify it. And I think currently a good example of this is a lot of the post-COVID investigations are grappling with exactly that problem, which is, to what extent was there a failure to identify the risk? If we identified it, to what extent was there a failure to mitigate it? And trying to figure out where the errors are, so that you can learn from that and improve in the future. Again, this is really relevant to what we do in investment, where risk management is a big thing. There's a couple of sort of mathematical technicalities. The way investment treats it is a little bit different to the way the government treats it, but broadly speaking, it's the same. It's trying to deal with that issue of how you identify things before they happen, and then retrospectively look back and grapple with this counterfactual issue about, what if we'd done something different? How would have that looked different? And I think, again, for something like the energy transition, this is super relevant, because climate change is a risk we have identified, and now we're in the stage of trying to mitigate it. And dealing with these counterfactuals about, well, what would happen if we did something different, ties into all of the stuff that I'm sure we'll come on to discuss around, looking at pathways to net zero and trying to hit 1.5 degrees versus 2 degrees, and how investment in different areas of the market can affect this. So those two things, I think, working with and sort of touching a little bit on the intelligence side of things, and then working in risk management, I think were the two big things that I pulled out of that second half of my military career, which really helped me transition into this new world.
Roman, this is brilliant. So you've done that 9.5 years within the military. What age are you at this point?
So I came out of the military in 2021 when I was 31-ish.
Okay. And so you're 31.
Early 30s.
Early 30s. Okay. And you've had that degree of experience. I must ask you, on what you've just described in terms of risk management, did you ever, this is a leading question and feel free to dismiss it for defense it back to me, but was there ever that sense of the sort of the thankless task, if you like, within counterterrorism of essentially, as you say, the problem is only your work is only highlighted when there's a problem with your work, as opposed to addressing and highlighting the value of what you deliver? Was that ever part of your experience of what you were doing, or not really?
I think you ask anyone that works in counterterrorism or any other area where they're dealing with identifying and mitigating risks in advance, and they'd say, if you want to do this, you can't do it for the recognition, for precisely the reasons that we've been highlighting, which is often when you get a success, you might not even know that it's been a success. Sometimes it has been a success, but you can't tell anyone it's been a success. And so if you're looking for recognition, it's just not a particularly good career to go down. And I think that's even more the case for people that work in the secret intelligence services, where I think they would all say you can't do it for the intelligence and for the recognition. And I was lucky enough to work with some of those people who are, again, just phenomenally impressive people who just do it, but in the shadows, as they say, and very rarely receive public recognition for what they're doing. But I suppose everyone, it's nice to be recognized when you get a success is the reality. So I think probably bubbling away under the surface, there is a little bit of frustration that everyone that works in that area needs to deal with, but it wasn't a big deal. It was fun doing what we were doing, and it was really professionally satisfying.
And I get the sense, looking back at your whole journey that you've just described so far, that that sense of service and that sense of impact, that was core back to early idealistic teenage days, if you like, and being a conflict zone journalist, all the way through to your decisions around your military career, etc. Let's focus now on 2021. So you've had this, as we've kind of gone through this amazing experience that you've looked at. What then drove you to look into finance and asset management? What was it that led you there?
Yeah, so I was coming out of the back end of my military service. I decided that I was going to leave, and I was looking for the next thing. And basically, I wanted to do something that was in some way facing the energy transition. Mm-hmm. And the reason that I'd ended up there is, to some extent, the similar reason that I ended up in the military back in 2011, 2012, 13, or why I was interested in it back then, was because then my reading of the situation was, like I said, that these conflicts that were going on were kind of like the big problem facing the world. And, I think looking back, that's a slightly naive view, but that's how it seemed to me at the time. I think now, when it was 2019, 2020, 21, but I mean, even earlier than that, and looking forward 30 years, the rest of my working career, it seemed like, the energy transition is the big problem and the big challenge. And the timing of my career aligns quite well into 2050. And on top of this, my brother-in-law is a guy called Rob West. He is a ex-energy analyst for some of the big research firms that work with investment companies like ours. And he now he's founded his own company called Thunderset Energy, which do really phenomenal kind of cutting edge research on the energy transition. And I'll probably come back and quote some of his facts and figures later on in our discussion. But he'd been throughout the period I was in the military, he was working in energy. All in conventional energy, and then he founded his own company looking more at energy transition and new energies. And so I had the benefit of 10 to 12 years. We've known each other. He was actually just a couple of years above me at school, so we've known each other for ages. And I had the benefit of over a decade of dinner time conversations and debates about the energy transition and public perception of it, and what was true and what was myths, and all of this stuff. And that really also informed the decision that I thought this was a really interesting part of the world to look at. So I thought, okay, how do I do it? I've got this weird background, I've got this CV made up of like numbers and letters that nobody understands when they read it. And I did an English degree, which doesn't really like make any sense, and doesn't, it's not like I had a kind of economics or like maths degree that I could go back and rely on. Mm-hmm. But again, I initially thought I would go into consulting. There's quite a well-trodden path between the military and consulting. And I did the level 1 of the CFA, the Chartered Financial Analyst course, because I didn't want to take 2 years out to do an MBA. I thought, no, let's try and get your foot in the door somewhere and get 2 years of experience. I thought that would be better than going and doing 2 years of education. Don't know whether the right choice or not. Again, impossible to measure a counterfactual, but that was the approach that I took. So in the last 6 months when I was in the military, I did this level 1 course, which it kind of covers it's a little bit more investment focused, but it covers, statistics, which I hadn't done since GCSE, micro and macroeconomics, corporate finance, all of this stuff that gives you the language to at least, turn up in an interview and have some idea what you're talking about when you're asked about, a company's balance sheet or whatever. And over the course of that, I thought, this whole investment thing is quite interesting, because like I said, that it has some very investment focused modules on things like portfolio management. I thought that's quite an interesting area. I didn't think I had a hope in hell of landing in one of these firms, because it is quite competitive. But again, I was in the right place at the right time. I knew a couple of the right people, and Hosking Partners, the firm that I work for, were advertising this new role to come in and be a kind of portfolio specialist, head of ESG, somebody looking at environment, social, government issues. Environment, social, and governance issues. And I'll come back to this and kind of describe for those listeners that aren't familiar with this acronym a little bit more what that means. But this opportunity came up, and it was to build out a new role or a new kind of an additional capability, a little bit of additional capacity for the firm, focusing on this area. And in the environment part of ESG, there's a lot of stuff which is looking at the energy transition. But I also knew that any investment role, particularly in a firm like Hosking Partners, which is quite long term, which again we'll come back to, you're trying to look at big problems or big issues, big challenges around the world. And the basic investment problem set, although I'm not here as an investor, I don't manage money, I'm not a portfolio manager, but I work with them. A big part of the problem set is doing something quite similar to what I was discussing before about, with a jigsaw piece. You're kind of trying to fit together disparate pieces of information, come up with a jigsaw puzzle of what the world looks like today, but also one of what the world's going to look like in 10 years. And then we do something different with that information and investment, but we're basically trying to find companies that you can buy today which are going to succeed in that world as you see it in 10 years' time, or at least where you build a portfolio of companies where you're diversified perhaps against a range of possible future worlds, because you can never be quite sure which one's going to emerge. And that ties again back into kind of risk management and how you deal with that. And fortunately, I went to a couple of rounds of interviews, and I kind of was just lucky that Hosking Partners were actually open to hiring a generalist rather than a specialist. And in fact, the whole team here would describe themselves as generalists by heart. And it's kind of a quite important part of the way we do business. And I guess, they were interested in my little flavor of generalism that I had, that I was bringing from the experience that I've discussed.
Roman,
years later.
No. Do you know what's this is one of the easiest podcasts ever, because essentially I just kick things off and you just speak so eloquently and beautifully about your experience and explain these different themes so wonderfully. So this is as easy as it gets. Two questions for you because we're coming to the end of our peering into you and your background. But two questions. You mentioned at the beginning when you were talking about journalism, and you were talking about like the impact that being the guy who finds the story that's then shared, that ultimately then creates that shift in behavior or that shift in perception or something in terms of the impact that it can have. Is there a synergy, if you like, between journalism and in investment finance, in the sense of right now you've got levers, if you like, in terms of what you can impact with the work that you're doing that are sort of akin to that in terms of journalism? Have I drawn a incomparable there, or do you think?
No, I think it's quite an interesting comparison, actually. I'm sure we'll get on to digging into, what impact investing is versus. Well, we'll try and pull apart lots of different kinds of investing, because actually the fact that in English we just have this one word, investment, is kind of unhelpful, because there's so many different kinds of investment that are really quite different, and each one of them has a different kind of impact. But journalism is an interesting comparison. I mean, the reality is that investment, often the impact is indirect. And there are direct impacts, but there are also indirect impacts. And we'll definitely come back to this, because it's quite an important point, I think, for what we discuss in the next part. But journalism, I think, is similar, which is that often the impact is indirect, and you need to get comfortable with that. And in investment, it's similar. Often your impact is indirect. And actually, I think, and I think this is a great segue. Often the problem that we've been facing, not we specifically, but more broadly as an industry and as a society, trying to get to terms with how sustainable investment works, is how to calibrate this issue of how to measure, calibrate, and then deliver impact where appropriate, but not seek to or misadvertise the delivery of impact when it's not being achieved.
And Roman, that you picked up on that brilliantly. I think that is a fantastic moment. I had a final query. In fact, before we jump on this, I'm going to finish with this one. You alluded to, when you talked about realizing the role at Hosking Partners, that you were looking at your background, looking at your career history, and thinking to yourself, this isn't the norm. I'm a generalist. I'm not a specialist, etc. Can you, for anyone out there, not necessarily looking to go into finance, but just anybody out there that's looking back at their career so far and thinking, I really want to head in this direction. Have you got any words of advice for them in terms of sort of, I guess, getting over, if you like, that sort of slight sense of imposter syndrome they might have looking at what they've done previously? Can you just offer some guidance to anyone out there facing that?
Yeah. I mean, you never get over the imposter syndrome. I don't think everyone suffers to that to some degree. But I think you need to learn not to let it guide your decisions. And I guess I can't remember who told me this. It was someone about 10 years ago. But one of my little rules for life that I've picked up is never deselect yourself from something. So there's never any use in taking yourself out of the game. Let someone else do it. You've got to build up a little bit of thick skin, because it will happen, and other people will take you out of a game that you're trying to get into. That's what happens when you get rejected in an interview. But don't take yourself out. So, and I think, to your point, there's absolutely a role for generalists, I think, actually across the board. There's a great book called Range, which looks at this exact issue, which kind of champions the generalist versus the specialist. Obviously, there are really important roles for specialists, but there's definitely roles for generalists within finance. Again, finance is a huge, even investment, like I said earlier, is a massive ocean of different roles and different types of firm and different types of asset class. And the suitability of a generalist in different ones varies. And there are some asset classes and types of investment where you really kind of do need to be quite a deep specialist to get into them. But there's others where they need generalists, and often generalists are slightly underrepresented. And I think this is something that the industry is actually slowly learning. And I do have an unconventional background still, but increasingly, you see, particularly in roles like mine, looking at issues like environment, social governance stuff, but also in risk management. There are increasing numbers of generalists who come from quite diverse backgrounds, and I speak to quite a lot of interns, and people that are coming straight out of university, and I always try and tell them, if you're trying to look at your career 20 years from now and figure out how can I be the most successful 40-year-old CEO that I can in the world, the answer probably isn't you need to work in one company for 20 years and build your way up right from the bottom. And there are people that do that, and that's a totally legitimate path. But there are also people who actually spend the first 10 years of their career doing something a little bit like me, which is completely disconnected from the next 10 years. And I think those people actually can often end up being just as successful, if not more successful, at age 40 than those people that hit every perfect job from age 21 through, that they get that Goldman Sachs internship and go all the way through. I think both are equally valid paths. And I definitely don't think the door is closed to anyone in this industry that has one of those more unconventional backgrounds. You just have to work it a little bit harder. And, look, the reality is I also knew the right people, and networking is massively important, not just in this industry, but in others. So the more networking you can do and the more people you can meet and the more little internships and work experience things that you can do early on, even if you end up doing something completely different for 10 years, but then you can go back to them. And it's so easy now with social media and LinkedIn and go, hey, I just got out of 10 years in the military. I'm now looking to getting into X, Y, or Z. You're in X, Y, or Z. What advice could you give me?
Roman, that was absolutely brilliant. I feel like you've just given, the careers advice of all careers advice there. I will add that to the bio of today's episode. That was fantastic, and thank you so much for sharing. I guess so much about your experience and background. I think it was genuinely inspiring and will be interesting for people out there. Can we move forward though? And can I ask you to perhaps just start by providing our listeners with a bit of a summary to the article that we shared with you from Macfarlane's, I think the title was Impact Investing in Greenwashing, Why Measurement Matters. Just give people a flavor and perhaps pick out what were the most kind of salient, most interesting points for you having read the article.
Yeah, sure. So, the article is getting at problem that I've been grappling with for the last 3 years, and there's many people in the sustainable investing. I'm a newbie. 3 years. There are people that have been doing sustainable investing in one form or another for 30 years. It's picked up in popularity. Terms like ESG and sustainable investing. If you look at that little Google search term tracker, it kind of spikes in popularity only really over the last 5 years. But in one form or another, this has existed for decades. Going back to mining companies back in the 60s would talk about their license to operate, which is basically talking about how you socially justify and environmentally justify the operations that you're trying to conduct, and make sure that the communities that you work around are kind of content with what the company is doing. And then in the early 2000s, you got corporate social responsibility was kind of the watchword, which is again, how can companies use the profits that they're earning, not just to reinvest in their own growth, but also to try and help the wider communities, which ultimately they rely on to generate, to go into the shops and buy the products which generate the revenue, which generate the profits, which sustain them. And what this article is getting at is now, again, this isn't a new idea, but it's gained prominence recently, particularly with relevance to the energy transition, is this idea of impact investing. And impact investing is basically trying to, it is what it says, it tries to do what it says on the tin, which is how can we use investment to generate impact? And it's like a really complicated issue, because we can go through this, but the cause consequence chain between making an investment of some type and that investment generating a kind of real world impact is more complicated than one might assume. And what the article is getting at is asking, given the goals that we have to reach net zero, to try and limit the negative effects of climate change going forwards, how can investors now, and by investors I mean everyone from you and me, paying money into our pensions or paying money into our ISAs, all the way through to the institutions, the asset owners that receive that money. If your workplace is paying a workplace pension, that will be paid to some large asset owner who will then distribute your money amongst a range of asset managers like ourselves, who then go out into the market, in some part of the market, and try and earn a return on that money, which then you get paid back to you 20, 30 years down the road if it's a pension, or day to day if you're tracking your stocks and shares ISA. How can that process also be used to achieve some real world impact, which can mitigate the kind of systemic big picture risks that society is identifying around issues like but not limited to climate change? And the article is basically, it throws up these issues and says there are problems here. How can we get at them? And one of the main points of the article, or the main angles that the article is going at, is measurement, and how can you measure impact? And this again is an issue that the industry has been really grappling with, because instinctively what financial professionals would like to do is quantify everything, because maths is the language they speak. Generally, it's very easy to quantify and build models based on the value that a company should be, because you can get its annual report and you can look at its cash flow forecast and you can adjust that and make your own. And you say, okay, well, it's earning this much today, but I think it's going to be earning X in whatever year. And then you discount back the price, and you're like, oh, well, the share price should be at this, but it's actually at this. And so I think this is a really great opportunity, or this is a really bad opportunity and we should sell it. And people love numbers, and you can then put them into Excel and build big models that do all sorts of complicated stuff, and spit out these results. And so the natural response of finance, when it's faced with a new issue, which is, okay, hey, how do we marshal money to the right places to try and address this big systemic risk that society has identified, in order to generate impact? The immediate instinctive response, the trigger finger response is, well, we need to quantify everything. How do we measure this impact? I need to be able to put this into my model, so that my model makes sense of it, and so that I can spit out a price, and that tells me whether this stock is more or less over or undervalued than I thought it was before. And there's been, huge amounts of money and time and effort poured into trying to solve this quantification problem.
Hmm.
And in my view, it hasn't really been solved. And we've got all of these large organizations which have popped up, ratings agencies which kind of try and quantify these problems. And what they're trying to quantify, just rewind slightly. So what is an ESG issue?
Hmm.
What we're trying to measure is this thing called a negative externality. And these are basically unpriced social byproducts of corporate activity. A really easy example of this is in tobacco. So there is a large negative externality associated with smoking, which is that it causes lung cancer and a range of other diseases, which if you catch, you then have to go and get healthcare for, which costs society money. So there is a quantifiable impact of smoking at one end, but how do you link that back to the share price discount that you should put on a tobacco firm?
Hmm.
And that's been around for quite a long time, and that's been an issue that's been grappled with, and to be honest, even that hasn't really fully been resolved. And now we're trying to apply the same thing to the negative externality associated with climate change. So how do we measure the impact that one or a different version of climate change or version of the energy transition will have on society, and the cost that it will bear on society in 10, 20, 50, 100 years time? And how do we discount that cost back so that we can pack it into a share price that we're seeing today on our screen, and understand whether, like I said, with the tobacco company, that company should be valued more or less highly than it is currently? And then how does that, then obviously that has an impact on, as an asset manager or an investor at home, choosing to buy a stock or not. If you're buying it at you basically want to buy a stock at the right price, and that's going to earn you the best return over the course of that investment. And so what the article is getting at is, how do we measure impact? Because we need to measure it in order to try and price it into all of these decisions that we're making. And it's not just as investors. The government is also doing this because the government is an investor, it's a big investor. And so the government is doing this when it's trying to figure out whether it should be, putting £1 million into solar or wind or whatever it is. It's doing a similar process of trying to measure impact. And that's basically what the article is discussing. It's discussing this problem around how you measure something which is intrinsically very difficult to measure, particularly over the timescales that we're talking about. And with something like the energy transition, it's not just about the emissions that a company has. To kind of get a sense of how difficult these things are to measure, it's quite easy to measure, the emissions, the scope 1 emissions of a company. So the amount of carbon emissions associated with its operations. It's quite easy to measure the scope 2, so the amount of carbon emissions associated with the energy it buys. Scope 3 is then, downstream emissions. It becomes really difficult. So, it should a car company include in its emissions the emissions generated by a driver driving one of its cars down the motorway or not? Or should that be included by the petrol firm that sold the petrol to the car? And you get into this kind of philosophical discussion about where this all happens. So that's emissions. And emissions should be easy to measure, because you can put a machine and just measure the amount of emissions. You can do the maths from the energy input to the energy output, and the amount of, there's very smart scientists that can tell you exactly how the molecules combust and how much CO2 that should produce. So theoretically, that should be easy to measure. Even that is really difficult to measure when you're then going, okay, I've measured that. How does the company X delivering Y amount of emissions today affect where society is going to be in 30 years' time? Because you get into the situation where there's all these reflexive impacts around, well, if company X changes the fuel that it buys to something more renewable, but then the cost goes up, and everything is reflexive, and it becomes a really difficult problem. And to come back to, I'll finish on that point. I mentioned about working in sub-Saharan Africa when I was in the military, and this is a kind of nice connection, golden thread through. We speak to investors in parts of Southern Africa who are really worried about the way that the West is approaching the energy transition, because the impacts they're seeing today, even though these parts of the world are the parts of the world that are going to be most exposed to the physical effects of climate change,
Hmm.
The transition risks they're seeing are that Europe has got its energy balance wrong. It's become over-reliant on Russian gas because it's closed down all of its coal and nuclear powered stations in order to try and be more sustainable. A black swan event then occurs in the invasion of Ukraine. All of the LNG, which was currently, the liquefied natural gas, which was currently, due to arrive in some port on the western coast of this African nation, gets rediverted midway across the Atlantic to Germany because Germany can pay a higher spot price for it. And suddenly, that African country, because of the way that they feel like Europe has approached this energy transition problem, is having to pay, 3, 4, 5 times as much for its energy. And if you think about how much energy makes up of your salary, the lower your salary is, the higher percentage of your salary is an energy cost. And you've got politicians and business people in these countries who suddenly have, riots on their doorsteps because their citizens can't afford food or drink or to heat their houses. And not only that, but then what do? Well, they have to go back to burning wood, cutting down a tree and burning wood, which is the only kind of fuel in the world that's even more dirty than coal. If you go and cut down a tree and then burn it, that's even worse. And so you get a negative environmental impact. So, hopefully that example just brings to life this point the article is making, to come back to the beginning, about how do we measure any of this? And even if we can measure it, how can that factor into how we make investment decisions?
Roman, I don't know whether or not to cry at the end of that, thinking what a hopeless task, or to just be absolutely in awe of what you've described. There's so many things to pick out of what you've just gone through. But in terms of that example that you provided with energy and sub-Saharan Africa, is that ultimately alluding to this notion of a just transition? Is that what that really highlights? The need that actually, if Europe had its time again, it would need to think about the implications of wanting to build a more sustainable approach to energy, and the wider potential implications that would have upon other sort of energy sources and requirements for energy around the world. Is that what the just transition is all about? Maybe just touch on that.
That's certainly my understanding of what it's all about. And I won't answer the question about whether Europe could have done a better or worse job. It's a massively complicated problem. I think is just the basic takeaway. And there is a lot of links between different parts of the world where the impact of these things is going to be different, and that has impacts on the geopolitical relationships between nations. And I think we're already seeing, some of the results of this. There's a great economist and historian of energy called Dan Yergin, who wrote a sort of encyclopedic history of oil. And I can't quote him exactly, but he has this theory that as the energy transition goes on, energy transitions by their very nature they lead to conflict. And he thinks that the kind of clash of nations as we go through an energy transition, particularly a badly executed energy transition, is only going to become worse as some of these discrepancies between the interests and incentivization experienced by different countries is exacerbated. That's exactly my understanding of what a just transition is, which is that energy transition is a global problem. We say that the molecular contents of Earth's atmosphere don't care where you've drawn a border on a map between one country and another. So even if Europe decarbonizes completely, that doesn't really make all that much difference if emissions in China, for example, have gone up 3x over the same time period. The net effect of the Earth's atmosphere is going to be negative. So it is truly a global problem, which is only going to work anywhere. The solution is only going to work anywhere if it works everywhere.
Roman, again, I feel like we might need to start the sort of Roman series if we can possibly convince you to come back on, because I feel like we're into sort of the forward, if you like, of a series, a series of things here. Let me ask you though, you mentioned about essentially the article did touch upon obviously the impact of measurement, or why measurement was so significant in terms of trying to address these issues. But then you've quite rightly highlighted that we spent a lot of money, a lot of time, a lot of energy going into trying to understand that and explore that, ultimately realizing that the whole issue is so complex and so complicated that those negative externalities that you've described can be difficult to unearth and difficult to identify and obviously difficult to quantify. Like, this is the $64 million question. I appreciate you might want to go into too much detail, but what is the hope for what we do next? Like, how do we go about approaching this? Do we need to invest more into measurement and trying to find those consistencies, or is there something else that we need to be focusing on in terms of, changing the way that investment and finance operates?
Yeah, sure. So the measurement problem is one problem, and I think the solution to that will continue to be being worked out in the background, ticking over. People will be coming up with all sorts of clever ways that we can potentially better measure some of these impacts. Artificial intelligence potentially can be helpful there.
Mm-hmm.
Concurrently, I think the key crux issue for us as in the investment community is, how do we rightly sell products to investors that clearly, and I mean, this connects exactly to what you do at the Anti-Greenwash Charter, that accurately describe the real impact that they do or don't have. So it's important to say here that at Hosking Partners, we aren't what they call an impact fund. So what an impact fund is broadly speaking, it'll go out and it'll say, hey, we've got two objectives, or at least two objectives. One of them is we want to try and make you a return on the money that you give us. So, we would like to earn whatever over whatever time period. But that's not the only thing that we're going to do. They say we'd also like to do something else. And, the article gets at this. And that something else might be, trying to improve solar penetration in Sweden, or some other task which is aligned with the desires of the investors that invest in that fund, and is achieving, some step towards helping with the energy transition, or some other problem which is not directly related to just earning a return on capital. But what's really important to understand is that the vast majority of investors are not impact funds. So the vast majority of asset managers only have one mandate. They only have one job. And that is to do, we have a duty in the asset management industry to do the best we possibly can for our clients. How do you define that? How it is defined to try and limit the problem set for asset managers and keep them aligned with their clients' interests as much as possible is financially. So it's to earn the best possible return they can on the money that they're given. The idea is, if you limit asset managers to that job, then it allows them to do their job the most efficiently. And then with that return, that allows those people whose money they are managing to make whatever decisions they want to do with allocating that money elsewhere, be that allocating the money towards a charitable venture, or indeed be that allocating some money towards an impact fund.
Mm-hmm.
Why aren't all funds impact funds? The reason why funds aren't impact funds is because if you adopt that second mandate to do something else in addition to earning a return, the reality is, unfortunately, you will almost certainly have to sacrifice some degree of return in order to do so. And there are a number of reasons of that. We won't go into too much detail here, but the key point is, if you want to achieve impact and earn money, you simply can't have your cake and eat it too. You have to give away a bit of your cake. I think there are roles for both of these types of asset manager. So managers who say, look, all we're going to do here is we're going to try and earn as much money as we can on the money that you give us. And then there should be managers out there that are saying, we're also going to try and do something else. The reason these two kinds of firms are important is we need to invest, trillions more dollars per year than we are currently investing in energy and society in order to make the energy transition happen. If money starts being given to asset managers who are simply delivering a lower quality of long-term return, that money just isn't going to be there in society. So although, we can argue about the pros and cons of capitalism writ large, if we take as an assumption that that we're going to stick with the sort of liberal democratic capitalist system that we have in place at the moment, the reality is that we need wealth generation. It has to happen. It has to not just happen in the West, but we need to try and help it happen in developing areas of the world as well. Because that frees up more money that we can put towards the important kinds of investment which will achieve impact. And the problem that we have in the sustainable investing world is that there is a third type of firm. And the third type of firm, which is formally the first type, so it only has one goal, which is to earn the best possible return. But that third type of firm, which probably makes up the majority of firms, is now being incentivized to tell people it's an impact fund. So you get a situation where you actually only have one job, which is make the best returns you can. But because of the way that regulators have either failed to or incorrectly regulated the industry, there are a lot of companies who are unfortunately incentivized to go and say, hey, we can deliver you impact because, and there's a whole range of ways you can do this, but most simply you can say something like, we don't invest in oil companies. That helps the energy transition. We're going to charge you a little bit extra on your management fee for the bother, but you should invest with us. This is sustainable. And, there are a huge number of firms that did pretty much this. And you can draw a very faint line between not buying a particular type of company's stock and theoretically in a laboratory environment, if everyone does that, that stock price goes down. That makes it a little bit harder for that company to do business because the cost it has to pay to issue to get new capital for growth goes up a little bit. It theoretically works, but in the real world, if you're just trading shares on a secondary market, so on a public market, if I sell oil company A's shares, by definition, someone else is buying those shares. So there's been no net change to the system. 88% of investment activity happens in these public secondary markets. Only, just over 10% is happening in private markets, where, actually your ability to lever effect is much greater because in a private market, I'm not just selling a share I own to you and we're just trading, it just exists above the company and the price of the share might change a little bit in the process, but basically I'm just giving a share I have to you. In a private market, you're giving new money. So in that first example, the company doesn't get any new money out of that. In a private market, if you don't invest in that company, the company doesn't get, the money doesn't exist. So you're having a direct impact for that company. That company, you can attach terms and conditions to that investment, and that company can then go and do X, Y, or Z with it. So if you're an impact investor, and this is the Impact Investors Network, which is a network that impact funds can join and be a part of, only 3% of the assets they manage are invested in public equities. 3%. It's hardly anything. And the reason for that is, if you're an impact fund, why would you invest your money in the part of the market where it's the most difficult to have an impact? You just don't do it. But the problem at the moment is that 88% of investment activity that's happening in secondary markets, just selling stocks and shares between people, because of a lack of good regulation, that part of the market is being incentivized, like I said earlier, to kind of pretend that it is having that impact. And this is hugely damaging. And it's just adding to this big problem that we haven't really discussed, around short-termism, which if we're trying to solve a long-term problem like the energy transition, like climate change, you just can't have a market that operates in a way where you're really only looking over a very short horizon and trying to, while concurrently selling a product to people which ultimately isn't doing what it says on the tin.
Roman, that was, as alluded to, that was a brilliant response. I'm wary that we've absolutely obliterated our normal timescales and things, which was totally anticipated by having met with you before. I do want to, I know we've got so many different areas we can talk about, but just picking up on that point regarding short-termism and short-term thinking and investment strategies. You mentioned at the beginning talking about Hosking Partners and the fact that you acknowledge and accept, obviously, that you're not an impact fund, but you also do look at that long-term strategy. Can you just touch on that and just, I think, maybe tie it together with the way that you guys go about positioning yourselves in light of the issues that you've addressed?
Yeah, for sure. So we're incredibly fortunate to have some amazing clients that have a truly long-term outlook. And because they have a long-term outlook, they incentivize us to have a long-term outlook. I mean, it's our approach anyway. The style of investment that we do is tailored towards the long term. Our average holding period, so when we buy a stock, we expect to hold it for at least 5 years, but often closer to 10 years. But even the portfolio more broadly is looking 20, 30 years down the line, because our clients are mostly pension funds. So they have a very long time horizon, because if you're 25, you're not receiving your pension, for potentially another 40 years. So they're trying to work over that very long term horizon. That enables us to be very long term in our approach, and it kind of permeates everything that we do, from the way that we think about companies and markets and the world, but also even through to the way that we calculate our fees. So we calculate a fee. If we do well for our clients, often what happens is that a hedge fund will just earn the extra money 20% performance fee just straight away, or, off. You could do 3 months good performance, you could maybe get another 20% hit. The way that we do it is it has to roll over 5 years. So we need to be doing well and outperforming for our clients over a 5-year period at least before we start to see any of the benefit of that work. And we hope that aligns us with our clients' longer term aspirations. Now, you could argue that, well, why don't you do it over a 30-year period? And there are just logistical and operational problems that you run into if you try and do that. But I mean, it's an interesting question for somebody to consider. I think, I noticed I watched a couple of your previous episodes, and I think if I had a magic wand to change one thing overnight, it would be to try and make the world think in a more long-term way, and particularly the investment industry, and try and incentivize the investment industry to be more long-term. But yeah, at Hosking Partners, we try and look at the world over long time periods, and we try and see through some of the noise and embrace the complexity of some of these problems rather than try and oversimplify them or overquantify them. So we are very qualitative in our thinking rather than quantitative. Clearly, we're an investment manager, so we do work with numbers, but rather than build complicated Excel models, we like to read, think, talk to one another, and try and figure out, okay, where do we think the world is going? Where do we think the money that's moving around the world is being concentrated? How is that money reacting to the way the media, the way public perception is changing? How does that affect the behavior of market participants, companies, and individuals that operate in these areas? And at the back end, what we're doing is ultimately trying to pick a collection of companies. We've got quite a large collection, about 350 stocks in our portfolio, that we think over the long term are going to do well. And one of the things that we look really closely at is, how are those companies being incentivized? So, is the way that their CEO paid aligned to, that company's stock price doing very well over the long term, or is it very short term? And we certainly want it to be very long term. How do they think about their strategy? How do they think about the risks that affect them? And this is where my role comes in, which is, really asking companies, how are you thinking about the risks around issues like climate change, like the energy transition? And is your thinking truly long term? Or are you thinking about, there's some regulation coming down the pipeline in 3 years, so it's quite helpful if we say we've got a net zero target. How can we hit that? Well, we can, if we buy a load of cheap carbon credits, then we can probably hit that. Or, maybe if we fire half of our workforce, we can, that's no good. We need people to be having long-term approaches to these issues that are sensible. But we recognize that the longer out in the future you go, the harder it is to predict. And generally, we try and not make big predictions about the future, but instead accept that there's a range of possible futures that could occur. And ultimately, what we're doing is we're tied to that duty we have to our clients to try and earn them a return, and over the long term. And we think that if you think in a nuanced way, holistically, about some of these problems that face the world, we think that you can earn a better return on that capital. But we're honest about the fact that we think that our role in the market is to try and wealth generate. And that if you wealth generate well, that leaves more space for other market participants and more money available for those participants to come in and have a real direct impact.
But
finally, I think the very final thing to say is one way that all investors can have an impact is through engagement and voting, and being active owners of the companies that they're invested in. So that's everything from just meeting with management, talking with them, learning what they're doing, but also on occasion offering our opinion about what we think that they could be doing better, or what we think that they're not doing well enough. And that's something that I really focus on, and that's coming back to where we started, that's an area that I try and have an impact through my work.
Roman, honestly, I don't. I love how you've even picked out the question that we normally conclude each episode with, and you've just given us your take on what you would do without even being prompted to do so. You've been you've been the most polished guest I think that we've ever had on the response.
Too kind. It's not true. I've watched some of your previous ones, and there's many that have been much better than me.
You've been absolutely fantastic. I think I'm just going to draw a conclusion from your point about the long-term view that you take to, yes, wealth generation and growth for your clients, but ultimately that long-term view enables you to have a more sympathetic understanding and appreciation of the ESG considerations that are likely to affect that outcome. And therefore, as you alluded to, if the magic wand could enable the investment sector to look more long term, then ultimately that would have an implication that these considerations would be factored in more effectively, essentially, which comes back, I guess, to the nature of the conversation that we've talked about. Thank you so much, Roman, for explaining things in a way that me, as an absolute, somebody with very little experience from an investment perspective, could actually understand and appreciate kind of most of what you went through today, which was brilliant. Really appreciate you joining us today. Thank you for your time. Hopefully you've enjoyed it too, and we might be able to get you back on for another show at some point.
No, it's been fantastic, Charlie. No, thanks so much. I mean, if anyone is interested, we do our own little podcast out of Hosking Partners. It's called the Capital Cyclists. We've got 6 or 7 episodes. We just started it last year, but we, give space for both external guests and our portfolio managers to discuss some of the other ways that we think about these issues and how we think about long-term investment. So if anyone's interested, check it out.
Fantastic. Thanks, Roman.